Ladies and gentlemen, welcome to the Capital Flows live stream. Hope the week is going well for you. Happy FOMC day. A lot of different shifts taking place. A little bit of volatility in markets that's beginning to shock positioning. Nothing, really unexpected if you've kind of been following along with the ranges that I've been laying out and what I've been talking about. So we're going to cover how to think about these larger macro changes as they relate to the transition from Powell to Warsh, talk about markets, talk about the forward curve, and one of the things I would say is one of the most important things that you can understand as it relates to the Fed is understanding how does this connect to the SOFR complex and short end interest rates, and how does that function as the asymmetrical linchpin for all of markets. And that's going to be one of the main ideas that James and I cover today in the stream. One of the things in the report that I sent out last night, right here, the FOMC setup, right here. At the end, one of the things that I talked about is that, and you can go to this video that I linked here, how interest rates are the asymmetrical linchpin on which the entire economy turns. And interest rates cause the rise and fall of nations because they're the direct input into the currency, and all goods, services, and assets are denominated in a currency. And so interest rates impact everything. And I would, strongly encourage everyone, read The Price of Time. Great story. It's, by the way, this is one of the few books that Scott Bessent and Stanley Druckenmiller both did a private video call with the author on 13D. This is when it first came out. And both of them said that the book really impacted the way that they were thinking about things and where we are in the world. And so I would strongly encourage everyone to read this so that you can understand the significance of interest rates. And again, this goes back to, this is very difficult for people to understand because we live in a nominal world, but everything is a pair trade. If you buy the S&P, what is that denominated in? Dollars. So if you're getting long the S&P, you are also fundamentally getting short dollars. You're saying, I think the S&P is going to rally against dollars in the same way the euro rallies against the dollar or the yen. And so everything in life is some type of pair trade. And that shift in thinking, once you begin to realize that, then you realize, oh, everything's denominated in the currency, which means that assets can go up just because the currency is being devalued. Inversely, everything can go down because the value of the currency is going up. And so, recessions are fundamentally about a revaluing of the currency. And so if you can understand that, then you can understand everything that takes place. And FOMC meetings, while everyone focuses on what's happening on the day of, the key thing will be understanding the second and third order effects of everything. And so James and I are going to be covering what's happening and then what are the second and third order effects. So James, thanks for hopping on. How are things in Bitcoin Vegas? Any updates from yesterday when we chatted?
Yesterday was the main conference day. A lot busier as expected, and generally speaking, just kind of the clientele you're going to expect. A lot of people that work. You know what I find fascinating is how many people work in the industry but really aren't in crypto. It's just a job for them. You got these big companies like CleanSpark or these wallet companies or whatever, and the people that represent them at the show, they don't really care about whatever is going on here. They're not part of the bigger story of crypto. They're just working a job and they know what their product does. And that's kind of the extent of it. Because you talk to them when you're at their booths or whatever, and that's it, right? So I find that interesting and not necessarily the greatest thing, right? But overall it was cool. Some of the talks were cool. If you guys don't follow, I really enjoyed Mark Moss's talk. He's a good follow. I think he speaks well to the broader just people about money and kind of how to think about taxes and wealth creation and stuff like that, and stop complaining about how the system works and is against you, and start using the energy of the system for you. I think I need to kind of learn more about that. And then Saylor was up there. He talked more about Stretched, which I was hoping he would talk about something else, just because I, at this point, have heard a million things about it. So did that, went to a couple side events. Vegas is fun, but ready to get out of here, ready to get back on the grind. And here we are at yet another inflection point, right? And one thing that sounds that always can happen sometimes is we have this really overzealous run into a moment where there's a couple kind of, we'll call them catalysts, if you will, like FOMC, last meeting, big earnings, and a lot of pressure gets put on a small amount of time, and you see these pretty outsized moves. So I think we could talk a little bit about how it's a little bit hard to stomach 2 very red days when you're still waiting for the outcome of a certain quote unquote catalyst, right?
Right.
Because you don't want to just because the price is moving, you don't want to just kind of capitulate before you've been able to get more information to help you make a good decision.
Yeah, absolutely. I think that timing your actions around these catalysts and knowing when to get aggressive and when to get less aggressive is key. I think the Paul Tudor Jones interview that came out, I think it was yesterday, the day before, was just so good because at the end of the day, you're still saying, how can I be patient to see when people are at their max pain, even on a short-term basis? When can I take the other side of someone else's trade? That's, I think, so critical. And I think that, as a reminder for everyone, the entire point of these live streams is to lay out the broad macro framework of what's taking place and then connect it to asymmetrical setup. So again, if you are brand new here, I want to, cover a couple things. Throw comments in the comments section so I can understand where you're coming from. The mission, idea, my goal in markets, map the macro regime to be on the right side of it, and find a few large asymmetric bets that can become home run trades. All of the slide decks and everything else, models, everything is laid out in capitalflowsresearch.com. And then all the proprietary research is sent out there as well. I sent out a paid subscriber section in yesterday's piece, breaking down a lot of the more niche views that are pretty high consequence for how we're thinking about today over the next several months as we transition. And, those will be reserved for paid subscribers. But if you were here and on the live stream, I would really encourage you to ask questions. They are free call options. And, go through all of the slide decks, spend time investing. Don't expect to show up and scroll through Twitter a couple times, try to click in and out of markets and expect to have exceptional returns. I mean, I think if the Paul Tudor Jones taught any of us anything, it's that guy is so locked into markets. He plans every single day the day before and spends time nonstop just thinking about and reading hundreds of emails a day, a ton of research. If you're reading 1 or 2 emails a day and maybe saving a couple tweets, you're doing like 1% of what he's doing every day. And you kind of wonder why he's the GOAT, right? Because he's literally going through all of this stuff and he's so locked in, right? I'm
going to add on to that real quick. Yep. I do think it's really amazing how much people underestimate the difficulty of consistently winning in this space. And just because you've found a TA model or something that fits you well does not mean like that's the end of the work, right? You just show up every day and, look for a couple setups and, like, do you really imagine yourself becoming a multi-millionaire through one method a couple times a day and the rest of the day you can go F off and do whatever? You know what I mean? Like, you got to think a little bit bigger, a little bit deeper. And I think that's where your stuff comes into play, becomes valuable, is it really opens your mind as to the depth of this game. And if you want to ever imagine sniffing the results of some of these guys, you got to do a lot more. And just real quick to add on to your thing, yep. Can you just let there's a new paid subscriber here asking where he can find the attribution models. Can you just go to your website and just show him quickly how to get that?
Yeah, great question. Thanks for bringing that up. So if you are a paid subscriber, I'm in a loop. It's just like that's
that. Is that an embedded Substack stream now?
Yeah, cool. It's an embedded Substack stream, and I was like looking. I'm like, where am I right now? Okay, so if you are brand new to the Substack and you're a paid subscriber, and you're saying, okay, how do I begin to lock in on all the research? One, start with the educational primers. Even if you're a paid subscriber, start there. And then 2, if you go through all of the reports that I'm sending out every day, in the section below, there'll be a paid subscriber section. And I didn't have one in the last couple before this because I've been working on a lot of stuff. But in the section here, you'll have all the paid subscriber stuff below here that free subscribers can't see. And you can go through those. And then what I would say is that the other thing that you want to think about is going through all the chats and all of the things that I'm laying out there. But the key thing will be, especially I'm hoping today or tomorrow, I'll have those attribution models sent out every single day for people so that they have a breakdown of all the flows that are taking place. And, soon I'll have a video that breaks that down for you. It'll be what I'm planning to do is a PDF breakdown of every single thing that you need, and then a video walkthrough of that. It'll be under 5 minutes, and you'll get that every single day as a paid subscriber. And that will really take you in depth to all the things that are taking place. So go through on that side, the things below the paywall, and you'll begin to have a clear framework of the more specific things that I've, kind of been laying out on the Substack for paid subscribers. That's going to be really one of the key things. Couple other questions here. I think this will be good. Reading the primers and use Claude and have it help you build these attribution models is going to be very helpful as well. I think that's really, really critical. I love this comment. Out of the womb, new to the stream. I think if you are brand new,
welcome to the fucking show.
Welcome to the party, pal. If you are brand new and you're just saying, hey, I'm starting from zero, what do I do? What you'll do, go to the educational primer section. This is an entire breakdown of all the education primers of every single thing that you want to know about macro markets. Go through all of these. Read all of them. If you don't have a Bloomberg, go through all the models right here. These are things that you want to have up every single day and understand them. Then go through all the PDF playbooks. Feed them into Claude. Feed them into whatever AI that you're using. And then go through the YouTube channel. Go through all of James's work right here. Go through all the book recommendations. Either feed them into Claude or start reading them. I would suggest that you read them and to understand what's taking place. Those are all going to be, very critical things. And then if you have questions, then spend time, putting them in here, put them in the chat, things like that. All right. Let's see. How do I reproduce the attribution model in Claude? You said available in the sub in one of your prior videos. I'll be sending out that attribution model. All the inputs, those remain proprietary and how I'm modeling them exactly. But I'll be sending that out every day so you can kind of have a clear breakdown of where we're at with things, and I'll be explaining that. So that'll be, really key to watch as well. And then there'll be, over the next couple of weeks, there'll be so much stuff for paid subscribers on the Substack. We're taking everything to a new level. It's constantly, it's always a little bit more work than I expect. And I'm, working through getting this entire dashboard into an output for all of you guys. This is the dashboard that I use for everything. And it's going to be the starting point for how to think about where we are as we relate to FOMC and how it connects to everything that's taking place. So if you are here and you have questions about the SOFR contracts, about where we are in macro, about the Fed, this is the time to ask them. Or you can also ask them in the paid subscriber chat. But here's what I'll start with. If you want to understand the Fed's actions, you need to understand SOFR and Fed funds. So SOFR and Fed funds, all they do is price the Fed's actions through whatever period of time. So right here, you have the forward curve. When we talk about the forward curve, you have all these contracts pricing what the Fed is going to do. So here in white are all of the contracts that are pricing what the Fed is going to do in 2026 and beginning of 2027. Then you have in red 2027, in green you have 2028, 2029, 2030. And these for SOFR are quarterly contracts. So these, happen every 3 months, and you can have a breakdown of what the market is pricing for interest rates over this period of time. If you want to understand how bonds work, all of it starts with SOFR and Fed funds, because the long end interest rates are just whatever the Fed is doing plus some premium for what people call term premium or whatever it is, duration risk premium, for how much more do you need to get paid to move out the risk curve, which has to do with the yield curve. So what you need to start with for interest rates, or when we're moving into any of this, for example, when we talk about the meetings, people are, what's going to happen today is people are going to say, well, we don't know what the Fed is going to do. Let me just say, we know what the Fed's going to do today. In our April 29th meeting, it's priced at 100% probability of a hold. If the Fed wanted to not hold this meeting, they would have said something by now, right? So the Fed functionally always does this. They either leak it or they do something else to indicate that they're not going to just come into the market. It's priced at 100% probability and just be like, oops, we're just going to change our mind. Like, that's not how the Fed works, right? If that is, what you're going to have is a lot wider ranges in rates, right? And so sometimes they do an emergency rate hike or cut. Typically, they're emergency cuts. And if that happens, there are a lot of other signals surrounding that. Right now, we kind of have an idea. We know that, that the Fed is going to pause today. But here's the thing. If the market is pricing a 100% probability of a hold, that means what the Fed is going to do today is already priced in. So when people kind of come out after the interest rate decision and be like, wow, I didn't expect, or I can't believe that they actually held and they didn't cut or hike. Well, you're not even looking at the market. The market's already priced that in. So if it's already priced to perfection, then that means whatever takes place is all about the second and third order effects of the Fed's comments for how they're going to act in the next meeting and the next 3 meetings, and how their actions reverberate across the risk curve. So that is, one of the key things to say, well, what is priced? And then what is the second and third order effects of that pricing? And one of the things that, we really begin to understand in terms of the pricing is, we have terminal rate, which just means what's the peak part of the curve pricing hikes or cuts, is pricing 10 basis points of hikes right now. So simply put, 2026, if we move out, you have, these contracts right now pricing higher interest rates right now. And you can see the implied rate that they price. So we have wherever we're at with the SOFR rate. And then we have, effective Fed funds is 3.64 right now. So what we need to say is the SOFR curve pricing a higher or lower Fed funds rate? And right now, through the rest of this year, the market is pricing a higher SOFR rate, a higher Fed funds rate. And so right here in this column, you can see an increase or decrease in what the market is pricing in terms of basis points. And the highest part of the curve is the H7 contract, which is in beginning of 2027. The market is pricing between now and the end, or beginning of 2027. This is the peak part of the curve. It's pricing 10 basis points of hikes. And now what you can kind of see is the shape of the curve right here. You have, us basically not moving at all through December of 2026, a little bit of a tick up, and then cuts priced into 2028. And then, you have a very interesting shaped curve right now. It's going up a little bit, then down, then back up. And so that's the shape of the curve. And the market is basically saying, the market is saying that the Fed is going to pause, maybe increase rates a little bit. They're pricing a little bit of a premium or discount there, cutting rates, and then they're up for the rest of the time. That's what the market is pricing. Will that happen? Probably not. What will take place is the Fed is going to, conduct its so-called forward guidance today. And what you want to be watching is how the market is pricing these changes. And one of the things that I laid out yesterday is that right here in the Z7 contract, so this is looking at the end of 2027, you can see that right now the market, it was pricing 25 bips of cuts between now and the end of 2027, and now this is moving up. We're moving back to this level where we're at a bit of an extreme for 2027. So, this is why one of the things that, I've been laying out is, this is why we see, the 2-year down on the day. And we're probably, especially, today, we are probably not going to make a new low below here, even as we move through the PCE print later this week, because the Z7 contract, which, I'll just overlay here, you can see it, SR3Z 2027. Again, you can pull this up on your own trading view. You can see that this moves in lockstep with ZT, right? Which makes sense because ZT is pricing short end nominal rates. This Z7 contract, which is pricing the amount of rate cuts between now and the end of 2027, is also moving in lockstep with this. And this up, we already have the Z7 contract already making a new low here, whereas ZT hasn't yet. And you can kind of see here, let me pull this up. You can already see here, and let me see if I have, there's an indicator for this where you can pull that up, but you can see that here, let me see what the level is. Here we go. So 96,340 right here. Oops. There we go. 96,340 is the level I'm watching in the Z7 contract, because if we move there, that will be us pricing a complete pause between now and the end of 2027. And that will be kind of the extreme. So right now, I don't want to be, I've talked about being neutral bonds and not wanting to be long bonds. So, we have, bonds rolling over a little bit on the day as we move into FOMC. Not really interested in shorting bonds. But the thing is, once we get to the short end right here in the Z7 contract, that will be a really, it's going to be tough for us to move below this level after FOMC. We might wick down a little bit or something like that. But overall, we are likely to remain above this level, which is pricing the amount of rate cuts between now and the end of 2027. And, my view is that we're probably going to remain in this larger range for interest rates. And in the interim, longer end interest rates might tick up marginally, depending on how we play through this entire dynamic this Friday, I think it is, or I believe it's Friday for the personal income and outlays data, where we have PCE. We're saying, okay, how much does this flow into things? So this is going to be a very important level to watch, because we're already pricing a pretty interesting situation.
Yeah, I think this chart's super interesting just from a trading perspective, right? Because if you're already like heading towards what you would consider maybe an extreme, right? You would need to see a fundamental shift that creates a scenario where that chart follows through to the downside, to where you're going to have to really consider your positioning, right? But if otherwise, this is a similar scenario, and I talked about this in a short I made the other day, is like, if this is another chance for you to just put on, it kind of sounds dumb, but like, it almost seems like another chance to put on the same trades in a similar
It really is,
right? Like it's like, all right. So if you see this chart go down there to that level and have like, how there's often like a level break that's been bounced on, a level's been defended a few times, then it breaks and it looks like it's kind of going the other way now, like, or
right,
a capitulation, but then it's a false breakout, right? It's like testing the waters almost, as if it's really a fundamental shift. I feel like that's kind of what you're saying here, where you could see even today or something, or like today or tomorrow, you could see that level tested, and like the market's reaction to that is going to be the most telling thing. Not so much like, oh, some tweets we see or some rhetoric or whatever, but like what happens with the actual like movement of that market through the next few days as like hedges unwind and people decide whether or not to put risk back on the table and stuff. And at that moment, you're going to have to kind of decide like, oh, okay, like in a weird way, this is a spot where I want to be adding to my position because everybody is looking at this the wrong way. Or, okay, this is proving that something is fundamentally shifting and I might need to consider trimming or flipping positions or something like that.
Yeah.
So
I totally agree.
When I see that chart, that's kind of what pops into my mind.
Well, when I see, when we see this go into, we're heading into FOMC, again, this goes back to my original point. Interest rates reverberate across everything. And, again, people don't understand interest rates a ton because they're saying, what are SOFR contracts? How does that impact long-end interest rates? What's the yield curve? I don't even know anymore, right? If you understand those and you spend time investing in that knowledge, it's going to make everything else clear. I mean, just notice, let me take crude off here. Just notice how gold and silver are moving in lockstep with this Z7 contract. Why? Because the amount of cuts that take place this year are going to determine where gold and silver go. And you will actually notice that the Z7 contract has moved lower, but gold and silver haven't. And we're moving into a catalyst where I would expect there to be limited downside here. Now, I don't want to bet on the Z7 contract moving up here because there's not upside in my view, maybe a little bit, but maybe there's limited downside, and that's been correlating with gold and silver. And so I know the driver for it on the upside and the downside. And so if we're going to have limited downside, you're probably going to have gold and silver as we move through FOMC, if this level holds in Z7, to begin to bid and move back up. And then if that begins to take place, I'll also be watching, again, Euro USD to do something similar. And I'd actually be more aggressive in Euro USD because you'll notice that it's actually been outperforming the rate side and also gold and silver, right? So you can see gold and silver, you've actually had a little bit of a divergence here, right? And you actually have Euro USD holding higher. And my view is that you're probably going to have Euro USD move up because, I don't think the Fed is going to cut. And now the entire, you're probably going to have, this level hold overall. But the better expression of that is Euro USD, gold and silver. And then if that begins to take place, then, it makes sense why, obviously crude is a direct input into that, right? You have this positioning where crude is now coming back up to highs. And, you have Z7 back at lows. And that, you have a very clear inverse correlation between both of these. So, now I'm watching crude and I'm saying, okay, if I see gold, silver bid as you have this level hold in Z7 into FOMC or out of FOMC as we, unwind some of these hedges, then you're going to likely have some selling pressure in crude. Now, if that selling pressure holds, then that will likely, it'll depend on how much geopolitical risk begins to take place further. If there's not enough, then, positioning will probably pull it back down. That's how I would think about those types of flows. What would you add to that, James?
I think that's spot on. And I think this is where I think sentiment would come into play, is where, all right, let's say this is some game theory running through your mind, right? You see this level in the SOFR getting tested. You see gold and silver holding their lows. You see the Euro USD holding its low and outperforming. If you start to see crude test these range highs here, and you start to see your timeline getting exuberant about oil going to break new highs, going to 150, loss of control, DBA, like, I don't know if you follow DBA, but like the agricultural basket is breaking to the upside, like all the inflation metrics, right? You're going to start to see sentiment towards inflation. You'll probably even start to see 1970s charts start to come back into play. You're going to see all these things. Those are signs for me of like, okay, well, to me, the asymmetric bet now might be shorting crude, or it
Right.
might be longing gold or silver, or it might be the Euro USD or whatever. Those, like, that's me relying on sentiment as another chapter in my story,
Yeah.
not as my be all end all. But I
Right.
think that's where like sentiment is the loudest from the crowd in like crude in this sense. They're not talking about SOFR, you know.
Right.
They barely even talk about silver anymore. The loudest thing is crude right now. So if all these things align, and then you get the timeline yelling about all-time highs in oil, that might be your signal to take a shot, because your risk reward is going to be very defined. You know,
Totally.
if you're wrong, crude's gonna go, SOFR's gonna go, gold and silver probably dump more. You know, it's probably gonna be pretty obvious that you're wrong. So your
Well, yeah.
downside is like capped, but your upside is you're fading the extremes here, and everybody doesn't believe it.
Yeah, exactly. And I think that it goes to, you have these different pages in a book, right? Maybe you can talk about that, about how you build a thesis a little bit. But now you're not just watching a single, oh, here's a technical analysis level in a single asset. You're saying, oh, well, there's this other asset. It's correlated. I know why. I know how, and you're going through that. Maybe walk through how you think about these pages in a book and how you build a thesis a little bit for you.
Yeah, I mean, we've been doing it the last 15 minutes, right? I just like that's why I like when people say like, what's your strategy or whatever, I have a hard time answering it, right? Because to me, every scenario is different. You're never going to take the same trade twice. It's like golf. Like, you're never going to hit the same golf shot twice. So a lot of things in golf in one shot, right? How's the ball sitting on the ground? What time of day is it? What type of ball is it? What type of club are you hitting? What's the distance? What's the wind? Where's the pin position? How's your back feeling? All these things add up to like how you're going to swing that golf club in the moment. And to me, it's the same situation here. It's like, what's the curve pricing? How are the related, the things you might closely relate to, which gold, silver, crude, how are those all acting right now? What is the read on each of those? Pile it up in all these different chapters, and all of a sudden you have yourself a little bit of a story, right? Which we just talked about. It's like, what is the market pricing right now? What catalysts are currently, being focused on, which is Warsh and earnings and PCE or whatever. And then you have, what are the correlated things? What are they doing? What's outperforming? Where is the pitch? Like the crude sentiment might be like the bell, like the loudest thing in this story. And if you put all that together, all of a sudden a trade pops out, right? It's like, well, how do I want to best express it? Maybe I'm a rates trader, and the best way to express it is like, I'm just going to fire on SOFR or something when I see the extreme. Or maybe you're an oil trader on hyperliquid and you're like, oh, hell yeah, I'm going to take the opposite side of this, throw on 6x leverage, give myself some breathing room, and monitor the situation.
Yeah.
Or I'm an inflationista, and like, this is exactly what I've been waiting for, and I'm long all of this. Like, I'm long oil, right? I'm fading this story. So it's to each their own, but that's how I construct trades, right? That's how I build into a thesis. And you kind of gotta, that's why conversations are good. Talking to people who have ideas is good, because like, you're adding, and then maybe you come up with something, maybe you don't.
Yeah, I agree. I think another thing to kind of build on this a little bit, and this is a great question from Matt, and let me pull this up. So here's Matt asked a question, and you can also put comments under the live stream as well in the comment section, or you can put up questions, and I try to get to those. I always go to the chat first because that's the clearest one. But Matt texted me about that, or DM'd me about this earlier, and he says, "Curious what you think about this relationship of long end rates as a trade. Know that you're neutral to bearish bonds, that long end or the currency will price the Fed's policy error. But with the complete regime change under Warsh, I'm interested if this correlation is expected to continue under the new Treasury Fed Accord going forward. Given the significance of the 10-year, I find it hard to believe they let it run beyond 4.50%. So I think there's a couple things that I would want to bring up here. because this is a great question. We're saying, okay, let's not just say like, oh, what's going to happen, but we're going to say, how should we understand this relationship right here? And so let's start with what these are. The 10-year is the 10-year interest rate. This is not short-end interest rates; it's long-term interest rates. So long-end interest rates price long-term nominal GDP. Short-end interest rates price the Fed's actions, right? Functionally, the Fed's actions. And so the idea is that you want to watch the relationship between the two. So first, let's note that during 2021, this is a very clear example, short end rates were pinned at 0. And what we had is inflation accelerated and long end rates priced the acceleration in inflation. And that reflects, that's why the curve steepened in 2021. That reflects what the policy error was by the Fed. Then what began to take place is inflation accelerated further, and then you had the Fed hike interest rates. The hikes in interest rates pushed up rates across the curve until we basically got back down to these levels right here, where you will notice that what began to take place is that long end interest rates began to move below short end interest rates, right? And we had a little bit more of a curve inversion and things shifted. Then what began to take place is as we made a top here and you had, short end interest rates began to make highs right here, you had right here the curve uninvert during this period of time, and long end interest rates went above short end interest rates. So now we're in this gap right here where short end interest rates are below long end interest rates. So that means that if you are a person who is saying, I need to buy some US Treasuries, are you going to buy 2-year interest rates and get paid 3.9%, or 10-year interest rates and get paid 3.39 or 4.39%? What I would say about this, broader picture is that the Federal Reserve primarily controls short end interest rates. Long end interest rates reflect the long-term nominal GDP that is in the economy, as well as how the Fed is impacting that. So, for example, we have a spread now between long-term and short-term interest rates. The Fed, pulled interest rates down last year, and then that pulled down long-end interest rates just a little bit, but long-end interest rates remained above these levels because growth did not deteriorate, and all the people calling for a recession year didn't really happen. So now we're saying, okay, we kind of have an idea about long end and short end interest rates. How do we begin to connect this to this other idea of volatility? So volatility, and this is implied vol of the MOVE index, prices the range of distributions in the options market for interest rates. And it's for, the MOVE index is for the broad kind of bond market. We would decompose that specifically for each contract if we're taking more specific views. But this is just basically bond volatility, broad bond volatility. Here, the MOVE index spikes right here, and right here, and right here, and right here, and then it's rallying this entire period of time when the range of outcomes increases and positioning is caught off sides. Because think about it, why does volatility increase in the first place? It's because traders have to come into the market and say, wow, something is happening that we didn't expect. Now I have to hedge my risk. And they buy puts or calls on the whatever the interest rate derivative is to hedge their risk. In the same way, in the S&P 500, something begins to happen and you say, I need to hedge my portfolio and buy puts because we're going down. People in the bond complex do the same thing, especially banks who are trying to hedge their risk. And so there's a ton of options traders and market makers in the US interest rate derivatives complex that are always trading these ranges. And so these spikes that occur are not about interest rates going up or down, but about positioning getting caught off sides, especially in interest rates, because typically, rates, these spike when the VIX, typically the VIX spikes when the S&P is going down, but that's not really the case in interest rates, because you can see, interest rates going down here and this spiking, and then the opposite happening when rates are going up, because volatility and options are about either side of the distribution, not just one of them. So we have that kind of baseline. Now we say, okay, we understand what interest rates are. We understand what volatility is. Now let's connect the two. And that connects to really how you should think about the current situation. What took place right here where bond volatility rose? Why did this happen? Basically, when bond volatility is rising, it's the market saying, hey, the probability of the future probabilities and the distribution of outcomes just totally changed. And then we would say, well, what drove that change? And the primary driver of that change was the crude market. Now, you'll notice here, and let me actually move that. Let's move this. All right. You will notice right here, I just need to take all of these brushes off. All right. You will notice that right here, this tells you a lot about positioning, especially moving into this week. Right here, you have crude rallying on the upside, which is dragging up the move index. That is an indication that people are caught offside. You have to remember that everyone who's trading bonds is sometimes, or typically, depends on who it is and all that stuff. But if you're trying to hedge your inflation risk, you do it with crude. So if you own a massive bond portfolio and you're saying, I want to hedge my inflation risk, a lot of times you'll buy calls on crude or buy crude or hedge your risk somehow. So when you have the initial inflation, move on the supply side, everyone knows that that's going to cause some inflation in the system, which is why interest rate vol moves up. So if you have crude prices and inflation risk move up, everyone knows that there's a higher probability of interest rates moving in a wider range to the upside specifically, which is why you had interest rates move up during this time as well. Now what's happened is vol has moved back down, and that is because there's less risk about the future distribution of probabilities. And the fact that crude is rallying right here, but it's not dragging up cross-asset vol, is likely an indication that the move up in crude is a bit more expected and it's not catching as many people off guard, which is why it's not really moving around equities or FX as much. So this is where you want to begin to connect crude with vol, with interest rates, and with FX and gold and silver in the notes that I made earlier on why gold and silver are doing the moves that they are, how that connects to the dollar, how that connects to real interest rates and everything like that. So what you have to recognize that all these flows are connected. These are not siloed flows. They're all the same people hedging their risk, changing their positioning, and adjusting in real time. So I think that's a great question. That's really how I think about all these moving parts and how they're functioning in real time. Couple other questions. James, anything to add on that you'd kind of like to break down a little bit more?
Oh, that was great.
All right. So I want to go through a couple additional questions for how to think about Powell's comments today. And again, this will all come back down to what we talked about. Again, if you're here, these slide decks are laid out on the website. Powell is, setting up for this regime shift. And now Powell needs to talk about, this goes to, actually, sorry, let me go to this other slide. This goes to Warsh's testimony. Warsh basically said that the Fed is a direct input into inflation and that basically Powell has failed. So this is Powell's last chance to set a bit of a precedent about his quote unquote legacy, because I don't think Powell's going to stay around the Fed. This gap right here represents basically Powell's failure. If they would have not changed their inflation targeting in August of 2020, we would have not had this massive gap where inflation ran really hot. And if they would have kept it at 2%, we wouldn't have had this massive gap in CPI. And so Powell needs to have a direct pushback on Warsh and what exactly he is saying, specifically about the whole legacy side, in my view. And so what we're going to be watching is how is he going to begin to shift how he thinks about interest rates or push back on that, because Warsh is going to come in and create a whole regime change. We talked about the transmission mechanism of the balance sheet versus interest rates, how the Fed has lost credibility, all of these different things. And so Powell doesn't really have a lot of power over the forward curve. So going back to this slide right here, where we have the SOFR contracts and how the market is pricing these changes, Powell doesn't have a ton of control over that. What he does have control over the next the next day, is how exactly the market is going to view his exit. And so that will be the entire question right now, how they're going to conduct forward guidance as it relates to the entire committee and how they're going to begin to shift, because everyone's trying to get a view on how the committee views everything right now as they see Powell leave, because they're going to be asking Powell, since he's leaving, they're going to ask him about his legacy. Nikki T, don't get me started on Nikki T. I think Nick Timiraos is going to be so salty that Warsh is not going to give him the same access as Powell. I doubt he will. I just doubt it. Because he's just basically played into Powell's entire hand, and just to get his book sales and everything else. But Nick Timiraos is probably not going to be the main guy anymore. But they're going to ask him all these questions about his legacy and all this other stuff, and then they're going to ask him questions about how the entire committee views all of the changes that are about to take place, because everyone wants to know, when Warsh comes in, is it going to be easy or hard for him to create this entire regime change? And Powell is a lens through which you can kind of view the committee and how it's going to function. Maybe Powell's going to go out with a bang. I don't know. But that is really what people are going to be watching. And because we already have the forward curve priced to perfection for this meeting, right? So we already have 100% probability of a pause, and basically a pause all through the beginning of 2027. We're priced in a pretty hawkish outcome right now. So that means that the risks are all about, where is inflation going to come in, and how does this regime change come from the side of Warsh? Because you'll notice right now, even into FOMC, you still have ZT sitting at these lows right here. And so this will be the question. And that's actually not a great chart to represent that, because we still have 2-year rates a bit lower right here. But that'll be the entire question about where we're at. So I think that's going to be really the key. All of these factors I'm going to lay out further. I'm going to try to do another video and report later today for paid subscribers on the website. So I'd encourage everyone, go to capitalflowsresearch.com, go through all the educational primers, become a subscriber there. You can go through all of the different research that I'm doing. And I'm going to kind of break down post the FOMC meeting, how should we think about these changes with Powell, Warsh, markets, the forward curve, and everything. So my view is that we have had a little bit of a pullback in equities. I'm not super concerned. We're down 50 bips from the highs. It's noise right now. We need to see how these hedges unwind through FOMC, connected to the larger macro flows and pictures and correlations, and that'll really set the stage for the next move in markets. So those are the main ideas. I'll be laying out those more on the Substack. James, any final thoughts as we're pulling everything together and for this breakdown?
I guess 2 things. One, I don't see Powell coming in and dropping a grenade before he leaves. He's just too buttoned up. I feel like he's the guy who just takes the high road. He's going to have a good little end game. Is it that I didn't really put 2 and 2 together, but this is kind of going to be the last time we see the guy, right?
Basically,
like in general. Just like Yellen, like poof, gone. You know what I mean? Off into the private sector or whatever he goes on to do. And it's going to be all eyes on Warsh, and we'll probably I'm sure there will be some point in the next 6 months where we're all going to say, bring back Daddy Powell, please bring him back. Warsh isn't the guy we thought he was, or whatever. Yep. Who knows? But I expect a cordial, non-extreme outcome today either way. Also, but who knows, right? And also, I forgot to mention, I met somebody last night. Shout out to John if you're out there watching. Lives in Indiana, and follows your work and is a good example of somebody who is implementing capital flows research into a normal life. Kids, he's a CPA, works for a wealth management company that helps people also incorporate Bitcoin into a normal way of like holding and building wealth. And he watches most of your stuff, and it's helped him create a better life for him and his family. And he's like been on just like a great track and learning all this stuff. And so if you're out there, doing other things too, there's hundreds and hundreds and hundreds of people with the same story. So I think that was pretty cool to hear.
I love it. No, those stories are super cool to hear, because I know that everyone has either different things that they're focusing on in life, or they're in different parts of the market. And, that's one of the reasons I love, digging in and doing everything that I'm doing, because I get to share it with everyone, and then they get to take it and be a expert in whatever, or be the best version of themselves in whatever domain they're in. And I love hearing that, because sometimes, especially guys, I mean, we've talked about this, guys that are just kind of crushing it with their family and life and in their community, and you go talk with them and they teach you so much about just life, right? And then you talk with someone else who's focused on some other niche market, but uses capital flows research for what they're doing, right? And then you learn more from them, right? And it's, I really appreciate the people who know how to take the research either that I do or other people do, and know how to integrate it into their life so they can bet on themselves, so they can invest in their own success and become the best version of themselves, bet on themselves. So I think that's always so cool to hear.
Yeah. And by the way, Cross-Eye Ministry, I see your comment up there from my channel. Go back and watch from the start. I know you might just be joining now. Go back and watch from the start. We cover everything you're asking. And, if you guys aren't, it goes back to the point of follow along this story. It builds, it stacks over weeks and weeks. And you are getting institutional grade information from flows for free, which is, I still don't think people really understand or grasp that. But that's why this whole space is amazing, because of what you can learn. So it's not, this stuff isn't gate kept anymore behind the king made institutions. There's people out there like Flows who are just trying to educate everybody on it. So take advantage.
Great stuff. All right, everyone, thanks for joining the live stream. Go back and watch the full thing if you haven't. Everything will be laid out at capitalflowsresearch.com. Go be a subscriber there. Go through all the educational articles. There's more free stuff than you'll be able to go through in a couple weeks. So just start going through all the educational primers. And I will catch you guys tomorrow, 8:30 a.m. Mountain Standard Time. I'm doing a stream every day. Catch you guys then.
See ya.